Oh, not now.
Oh, sorry.
What's up, everybody? How's it going? Welcome back to Retail Weekly. I'm Ronnie. That's Nick, and that is Contrarian Capital, our other co-host. Our first co-host that's not me or Nick. So great to have you on, Contrarian. Really loving your work that you're putting out there, putting a lot of due diligence out there on a lot of great names. And today we kind of brought Contrarian on to talk a little bit about Root, a new name that I've been in and started a position about a month ago. Brought it to the attention of my community a month ago, and just really been dollar cost averaging into that. We're also going to talk a little bit about Oscar. We talked the whole Retail Weekly was about Oscar last week, so we can kind of talk about some other names, maybe some Zeta. Zeta had a 10% move yesterday. We can talk about Root, and we can talk about some Delo and maybe even Rivian. I'd like to get Nick's thoughts on Rivian today, as that one's kind of been up and down and all crazy. So is Oscar a little bit, but cool. How's everybody doing? How's everybody's week?
Good. How about you?
Good.
I'm good. And solid. Thanks for having me on. I appreciate it. Excited.
Yeah, of course. Yeah. Excited to have you on, man. So Contrarian, I guess you can kind of take the floor and talk a little bit about yourself and how.
Yeah.
Yeah.
So let's see. I started investing in 2018. So I've been like picking stocks since then, doing a lot of ETF as well. Obviously, I think that's a good idea for almost everyone. But I at this point run a pretty concentrated portfolio. So like 4 to 5 names at any given time, mostly swing trading. So not in that portfolio holding on anything that for like years and years, but looking at names like, all right, what's really undervalued that's going to re-rate right here. And so I really try to find these names that are like just really mispriced. A great example of that would be, UnitedHealth recently, something like that, where you're just looking at it going like, it can't sit here, right? And so that's really, I feel like that's where I can find alpha. And so that's what I like to do. And yeah, I'm excited to kind of get to share with you guys what I think is one of those picks today. That's what I share also on Twitter. It's like, or X, I guess. Do you have any questions about that or should I just start?
Yeah, don't worry. I say Twitter a lot too, by the way. So
yeah, guys, if you're watching, you're not following Contrarian Capital, he posts a lot of great stuff on X. So definitely go give him a follow, guys. Super great content. He's gonna talk to us a little bit about Root. We'll just jump right into that. My quick little spiel on it. I posted a couple things about it. I posted the high five snapshot. I posted a little due diligence on it. I'll continue to post a little bit more here and there, but really it's Oscar, but for car insurance, right? It's really like, if we want to simplify it, break it down, if you really want to be good at investing and have conviction in a stock, you need to be able to put it in 1 to 2 sentences. It's Oscar, but for car insurance. Yep. AI, car insurance disruption. That's like your bam, there it is. That's what we're really talking about. But I'll let Contrarian kind of talk about it a little bit here. I might pull up some stuff on this side of things while he's talking about it.
Yeah, absolutely. So I think to kind of understand this play, first you got to understand, especially a lot of us who are in retail investors, we tend to focus, I think, a lot on tech. And what kind of gets missed there, that is definitely not missed by institutions, is that tech is, while huge, not the only market. Insurance is both nationally and globally just such a massive TAM, right? And so where you're going to find a lot of alpha as well is in new tech-enabled AI insurance companies, because these companies are boring, they're slow. I mean, if you go into their back offices, most of the time they're running very old code, they're doing a lot of stuff by hand, they're faxing paperwork. And so there's a lot of money to be made if you could just do what they do more efficiently and better. And one of the key things there is you want to do what's called underwriting really well. So what is underwriting? Underwriting is the process of saying, how much should this policy cost? If I'm insuring your house, if I'm insuring your car, if I'm insuring your health, what should I actually be charging you? And how can I make sure that what's called my loss ratio is as low as possible? So my loss ratio is, for every dollar that I bring in premium, how much of that am I paying out? Now, there's really a couple of key companies that are doing this in the insurance space overall. Obviously, Oscar is doing that with health insurance, which is a very tough market, and they've had a ton of success there. The other big market, the two big markets in the US are going to be home and renters and car insurance. And so with renters insurance, a lot of people know Lemonade. And in car insurance, the biggest name is Root. So the thing that Root does really well, they use AI to both optimize back office stuff, be very efficient, very lean as a business, and they do a great job of underwriting policies. So they will use a app on your phone to figure out, are you a good driver? Are you driving around late at night? Are you slamming on the brakes and like turning like crazy? Are you driving safely during daytime hours, etc.? And based on that, they can price your policy better than other people, or better than other insurance companies, rather. And so that's really where their alpha comes from. And it's a very systemic, very like core to their business moat that's going to be very hard for these other companies to really get in, because yeah, they can make an app. They've been doing this for years, but they don't have the AI model that's really going to allow them to take that data and actually figure out what is the right price for you. So I think somewhere in this investor presentation, they do actually have their loss ratio over time, and you just see it steadily falling and falling. And that's really why they're going to outperform, because they've got just really good underwriting. And when you have that combined with, for them, they're not even in all 50 states yet. And so that's another huge piece of this thesis, that as they expand, they're going to see naturally a ton of growth there. Now, with that, it's important to understand how they get customers. They have really good customer acquisition costs, what we call CAC. And the reason that they have that is because of their main model to push their policies to customers is what's called embedded insurance. So when you go to Carvana and you check out, they are actually offering you, do you want to sign up with Root right there on the spot? And they're able to get a lot of people that way, because when you buy a new car, now all of a sudden you do need car insurance. And so they're able to catch you right at the checkout point. And yeah, they're only in 35 states. They're missing some of the biggest, wealthiest states in the country, New York, Massachusetts, New Jersey, Washington State. As you move into these states, you're going to see natural growth, and you're going to see it expand very quickly because of that embedded insurance model. They're not just with Carvana. They also have a deal with Toyota. They also have a deal with Hyundai. So they're going to see a lot of growth very quickly once they are authorized in these states. And so you can see that right graph is really what I'm excited about. I think they've got a ton of driving data, and that's what's going to allow them to have that really good model. And in the middle graph, you can see the growth of embedded over time as how people are going to buy their insurance. And obviously, as they grow into a bigger company, they'll attack those other distribution channels as well. And so that I don't think I missed anything there. Is there anything else you can think of that I should talk about with regards to? Could you pull up the stock price chart?
Yep.
Yeah. So there, what you're going to see is after their last earnings, they fell pretty dramatically. So you can see that's a massive red candle right there.
24%. Yep.
Yeah. And so, investors might be looking at that and going like, all right, well, what happened? Did like something explode? No, most of that comes down to non-cash expense due to warrants. So if you're not familiar with the term, warrants are essentially a agreement between two businesses that allows one business to buy shares of another at a certain price. And so when Carvana and Root entered into their agreement, the way that they did it was Carvana basically said, we want warrants. And Root said, you can have these warrants and they will vest once you initiate a certain number of policies. And so once Carvana generates 100,000 new policies for Roots, they get some warrants. Once they generate 100,000 more, they get some more warrants, so on and so forth. And what they're basically running into is that they are not going to end up exercising those warrants. And so investors thought Root was going to get a bunch of cash, and most likely Root is not getting that cash on hand. That's a non-cash expense, but it's not, in my opinion, a bad thing, because you avoid a little bit of dilution, and they don't need it. They're a profitable company today, which is really important to mention, because they're trading at a pretty basement price to earnings, in my opinion, especially given their potential for growth and disruption. And that's kind of where my interest in them comes in, because I don't think that they can, really sustain this low of a valuation for very long. I think the market's going to see them re-rate. Yeah, they're making money, and that's not something Lemonade can really say right now, which is the best comparison. Lemonade's way more expensive as a price to sales, despite not being profitable and not really projecting profitability for about another year. And so all that taken together as a whole picture, very solid business, very solid valuation, it's going to re-rate. And I think it's a great opportunity right here, in my opinion.
Yeah, I really like this name. When I pulled up the fundamentals, it's just the first thing I do is I run it in my snapshot. When I hear about it, when I see it, I run it through my snapshot, and I just say, is this even worth looking into, right? If I'm throwing in conservative assumptions and it's just, sky high valuation, sometimes I'll just be like, yeah, I don't think it's really worth looking into. But with Root, it's like an Oscar and Onto and D-Local and Zeta. It's like you throw in the numbers, you throw in like dog crap numbers, and you're just sitting here, you're like, wow, there's still a buy if like everything were to go wrong. So it's just one of those things. I really like this name. I know there's a lot of lemonade bulls out there. I own a little bit of lemonade. For me, I just, I like to have some positive free cash flow. I like to have positive net income. I like to have something that's different, right?
And and like saying Root's a good buy, just to be clear, isn't saying Lemonade's bad, right?
Yeah,
They're
exactly.
a great company in their own right. The Bulls have a great thesis there, but I just think that this is kind of hard to ignore in terms of where it's trading at right now. Feels pretty clearly mispriced as a stock.
Yeah, so if we just do the revenue right now, guys, Root is way outpacing Lemonade. If we look at the net income here, we can see that Root is positive net income, has had a very nice ascent higher to being net income positive, where, again, nothing against Lemonade. It's just like, since 2020 when this stock went sky high and I first heard about it and everybody was saying they're going to be the future, they're going to be blah, 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 blah. It was all hype in 2020, 2021, and then it absolutely crashed and it hasn't even come close to those prices, right? Again, I'm not talking crap. I'm just saying what's happened. Like if we pull up a chart of Lemonade, it absolutely went sky high, guys. Sky high. We're talking about $187. $187. They weren't profitable back then. They didn't have net income. They didn't have free cash flow back then. But it was absolutely a euphoria in 2021. And they had this massive fall. Look, guys, imagine buying $187 and it fell down to like 10. I mean, you hate Lemonade. You despise this company if that's you. And that is some people. That is. It's part of the game. Now, are they making more revenue now than what they were? Of course. Of course they are. But if we look at Root, right, they had a similar situation. And it's kind of funny, though, because can we talk about poor timing? Poor timing for Root. Root sees Lemonade absolutely going ballistic. Root or Lemonade IPOs, right? And let's just pull it up side by side. So can we talk about inverse, guys? Come on. Root IPOs the same time as Lemonade, basically. And, one goes just absolutely ballistic, and then Root just goes straight down the gutter.
Yeah.
It's kind of funny, but look what's happened since, right? You kind of have Lemonade and Root now following the same path. But the biggest thing now is if we pull things up, Root has better revenue, like we just said. Root actually has net income. They are net income positive for the past 4 quarters. So they hit their first year of positive net income. Also, if we look at the free cash flow, Root has positive free cash flow now for 1, 2, 3, 4, 5, 6, 7, 8 quarters in a row, where Lemonade has only had it for 3 of 4, right? I do like that Lemonade is starting to get that free cash flow. I think that's where majority of businesses that are high growth, majority of businesses first get free cash flow figured out, and then they get net income figured out. Right. And the great thing about free cash flow is that it is you can't really manipulate it. Like you can manipulate net income with non-GAAP, GAAP, all this different stuff, right? But with free cash flow, it's pretty black and white, right? So
Is this stock-based comp adjusted?
on this, I don't know. I don't know.
No worries.
But we can pull that up too and just see.
Yeah, and I think for all the lemonade bulls out there, I don't think that it's a bad company. I think that's probably fairly priced, and so what that's showing us is that Root is mispriced.
Yes, exactly. Yeah, so shares outstanding. This isn't even really that bad to me.
No, that's not bad at all.
This
For a
is
growth
just
company,
a
that's
slow, very slow grind up. I mean, I'll be honest, as a Zeta bull, they got it under control now, but it's very different seeing that compared to this. This is extraordinary to see something like this, then like just a giant step higher, and then this like climb. But again, they have it under control now. They're bringing it down. Right. So, yeah, I really like Root. I guess we can go into Nick. Have you looked into this name? Have you heard about this name?
I have not. No, I
Okay.
have not.
Yeah. So the great thing, Nick, is it's still in my regard, it's still a screaming buy.
Mhm.
So these are my levels that I share with everybody. So we're in the DCA zone right now. Basically, all you really need to know is my fair value based on discounted cash flow is $156. We're currently at $99 per share.
Okay.
So based on EPS, we're looking at $144. So if you're looking at it on EPS side, you're undervalued. You're looking at it on discounted cash flow side, you're undervalued. So, and this is another thing. This is very similar looking to me to Oscar Health. Oscar Health is expected to have meh growth over the next 10 years by analysts, but I actually believe they could have, mid to high teens or 20% plus growth over the next 10 years on average. I think Root is the same way, right? We have to realize there's so many companies out there, car insurance companies out there that, are kind of old school, like Contrarian was saying. They're old school, like Nationwide and Allstate, they're just very old school. Maybe they have good commercials, but the tech's not really there. And they're definitely, just trying to, get by and make as much money as possible off of us.
Yeah.
And investors, I mean, what we care about is, customer acquisition cost. Commercials don't give you good customer acquisition cost. You can sponsor the Super Bowl all you want. End of the day, how many people are signing up based on that versus how many people are signing up based on, hey, I'm buying a Hyundai right now and they're offering me a pretty good rate and I can, they're going to think to themselves, oh, I can go back and check rates later, but right now I can get on the road, and they're not going to go back and check rates later. We know how consumers behave.
Yep.
It's just great unit economics for them.
Yeah, fully agree. And yeah, I mean, if we just, guys, sometimes it is like I'm using visual stocks here. If you haven't used their site before, they're a really solid site. But look, I mean, you literally they figured it out in 2023 and they've just been on a steady climb higher.
Yeah.
Quarter over quarter growth, guys, quarter over quarter growth consistently since 2023. The net income consistently rising, consistently getting figured out now to being positive. And then even the free cash flow. Yes, on a quarter over quarter basis, typically you're not going to get just a hockey stick with, especially with insurance companies, but consistently they have positive free cash flow. And if we just bump this up to the yearly, you can see, okay, we had the big flip and now we're free cash flow positive, 183 million, 184 million. Net income positive about 31 million in 2024. And just look at this, just massive year in 2024. They're following that up with another big year in 2025. So it's not a one-off either.
And what's really interesting to me about Root, you look at these, right? And you could like ask a toddler to do this, where you just ask them to guess, is their next quarter going to come in, EBIT, whatever metric you want to use, above or below 0, right? Mm-hmm. I think personally, it seems really straightforward to say they're going to come in as a profitable company next quarter, given that it's going to be more or less the same situation as this quarter plus a little bit of growth. The analyst expectation right now for EPS for next quarter is negative 30 cents, which is like, I think that alone is accounting for a lot of this mispricing. because of the fact that institutions kind of have to do what their analysts are saying, right? You as an institution can't really say, oh, I think my own analysts are wrong. And so when analysts finally catch up, I'm getting the number off Robinhood. I don't know if this number is different. But when analysts,
it doesn't matter. Yeah, it's all good.
You're going to see institutions now turn around and start to look at this, and this market cap is small. This float is small. And so they're not really going to have, that is going to send the price up very quickly, I think. And it's a matter of, in my opinion, when, not if, that starts to happen, because things like this don't typically persist in the market very long. We understand the market can be irrational for a very long time, but it's not usually the case.
Yeah, it's simply undervalued, and there's simply fear, uncertainty, and doubt around it over the Carvana fiasco. And when you get fear, uncertainty, and doubt around anything, analysts and Wall Street overcompensate in one direction or the other, whether it's bullish or bearish. Right now, we're seeing that overcompensation down on the bearish side on Root, and it's just being completely mispriced because of the Carvana scare, because they think it's going to massively impact them next quarter. And even if it does, even if they have a negative quarter next quarter on EPS, analysts have them bouncing back to positive.
Yeah.
Going through 2026 and 2027. Look, a company isn't built on quarters, it's built on years and decades, 100%. Right? So I don't care, right? Do I want this? No. But again, it's you running your projections, you running your numbers and realizing, okay, why are we why is the stock going to be basically $50 to $60 undervalued, right? Just because of possibly this. Now, if they come in next quarter and they actually have positive EPS, you're going to see one of those D-local type moves, Zeta type moves after earnings where you're popping 20, 30, 40% after earnings, guys. Yeah. It's going to be absolutely massive. So, I mean, yeah, you can clearly see it. I've been buying since 80s, right back here. I didn't know about the company back here in, end of 2024, or maybe I would have been buying back here too. But I'm completely okay with have about 60% of my position built out, and so do my community members. And then, we're just going to be DCAing now our next 40%, selling cash secured puts, whatever we got to do to finish building out our position. And then we're just going to sit back and wait, just like we're doing with Oscar. So, yeah.
I've actually talked to a couple of people who are customers, and they're super happy with it too. They like the app, the experience. It's all very smooth, all very anecdotal data, obviously, but it's just, I think, every technological aspect of this business is going to be a little bit further ahead than what you'd get from Geico, right? Because they are a tech first company. And I think that stuff does matter as you go for years and years and years. It's a small edge, but it really builds up over time.
Yeah. Couldn't agree more. And these are kind of their competitors, which I don't know any of these names, by the way, but Fidelis, Pro Assurance, Chapurian. Yeah.
Can you plug in competitors? Can you edit, change the? You could try.
You can. You can actually.
Yeah, you could try Progressive. There's another big auto insurance company that's publicly traded.
Allstate.
Yeah, Allstate. That's the one.
And we'll throw in Lemonade too, since they bought out that company and they're in the.
Yeah, Lemonade does offer car insurance, but they bought Metro Mile for people who may not be familiar, which was a similar company. And Travelers is another one. TRV is the ticker for that.
Guys, I'm just going to say this immediately. Guys, Root is a $1.54 billion market cap. Lemonade is a $3.73 billion market cap. I just really want to make this point real quick. This is where hype can get you a higher stock price than fundamentals. So if we just look at this real quick, Lemonade versus Root, and we're simply just going to look at revenue. You have Root as of last quarter doing $383 million, and Lemonade's doing $164 million. Root is doing double the revenue on a quarterly basis. If we look at a yearly basis, they're doing double. Guys, Seriously, they're doing double the revenue that Lemonade is doing. But Lemonade is a $3.73 billion company, and Root is a 1.54. So almost 3 times bigger Lemonade is than Root, strictly based off of hype. And I guess people's projections for Lemonade, okay, whatever. But who's profitable right now? Root or Lemonade? Root. Who has free cash flow right now? Root or Lemonade? Root. Who has more revenue? Root or Lemonade? Root.
It's
So
going to
again,
take Lemonade a long time to catch
saying
up
that
to.
Lemonade's bad. It's just saying, well, it's either saying that Lemonade is super overhyped, blah, 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 or Lemonade's probably fair value and Root is just that severely undervalued. It's one or the other. I think it's Root severely undervalued. And if that's the case, if Lemonade's pulling $3.73 billion in revenue, then Root should be priced at $5 billion in revenue or $6 billion in revenue. Would you agree with that, Contrarian?
Yeah, I mean, I don't see a single metric on which this name, if it doubled overnight, would be overvalued.
Yeah, I don't either.
A double is like, if you can get that in 5 years out of a stock, that's pretty good.
Yeah. And it's funny because I have $150 on it, which is $50 higher. So it basically only takes it to like a $2.5 billion market cap.
Right.
That's really it. And the thing with my projections is I run them very, very conservative, very, very conservative. So I'll pull it up here. So we're talking about 10 and 12% free cash flow margin rate, which I believe they're doing like 15 to 20% right now on the free cash flow margin rate. We're talking about a terminal value of 10. So in 10 years time, they are only going to have a multiple of 10 for their free cash flow, or for EPS of 20. Well, I mean, if they become into a solid company that has a very strong hold on, the car insurance, and they do other insurance as well. They're not just car insurance. So
they're expanding. And I think the nice thing about what they did was now they have the car insurance as both a fast growing side of the business, but also like a cash cow side of the business almost.
Yeah.
And so they can take some of that to use to get the data for how to now underwrite things like home insurance, how to underwrite term life insurance, things like that. And they can, to get that data, the reality of the situation is you're going to need to price some policies badly. You're going to need to mess up, you're going to get it wrong. And then that's how you're going to learn to train that model to get it right. And so they're going to be able to eat those losses and expand that much faster. And so I think that's another piece to the growth story that people don't really realize. And their loss ratios aren't going to just flatline from here. They're going to keep going down. And I think either they're going to keep going down or everybody else is going to start to lower their prices. And realistically, if that's the market that we get into, I can't see these legacy guys really continuing to compete with Root, because if you turn it into a price war, these guys are going to win really, really easily.
Yeah. It really reminds me of Oscar. With the SG&A cost just continuously just plummeting down lower and lower, which are just driving down costs with AI, really at the root of it.
I think one thing that scares a lot of investors out of Oscar is that there's a lot of litigation risk and there's a lot of just policy risk that doesn't really exist with Root, right? Unlike health insurance, which is highly regulated, and there may or may not be subsidies. There's no car insurance subsidy to like be taken away. There's nothing in that realm. The law isn't going to change. You're going to need car insurance, and they don't. That's a cloud of uncertainty that I think is giving Oscar investors an opportunity right now. But it's something that doesn't really apply to Root, which is in a way a good thing for people that just feel like, oh, I don't understand healthcare insurance. This is just so much of a simpler business to get into. And so I think if that's giving anyone doubt, it's nice that that's sort of not a factor here, at least not nearly as much.
Yeah, I mean, can we just talk about this? 2023, they did $445 million in revenue, $132 million in SG&A. They jumped up from so basically over doubled their revenue from 2023 to 2024. And they simply only rose about 70 million on SG&A. That is very, very good. To be able to double your revenue and you didn't even double You didn't even double your SG&A. Phenomenal.
And you don't get management teams that good very often, quite frankly.
No.
And that's something I think the market has a hard time pricing, but like good management is such a moat.
Yeah. I mean, whenever you have this hockey stick pattern going on with the revenue quarter over quarter over quarter over quarter, but then you're barely rising, like their SG&A is where it was in 2022, right? But look at 2022 revenue compared to 2025 revenue. I mean, this is just very great leadership. Very great. This is just great leadership, guys. I mean, there's no other way around saying it. And look at this debt. The debt has actually come down over the quarters, and while cash and bonds are rising. I mean, this is like I feel like sometimes the light gets shed on a company and it's like, this is the only company, this is the greatest company in the world, and like that's Lemonade right now. And again, not knocking Lemonade, it's just like, where's the love for Root? Because what doesn't Root have? They have better revenue, they're growing faster, they have free cash flow, they have net income, they're bringing down SG&A costs as revenues exploding, their cash and debt are rising, or their cash over debt is rising, they're controlling their shares outstanding, their premiums are rising, their cost of premiums are going lower. One question I had for you, I didn't look too much into this yet. With health, and I probably already know the answer. It's probably a no. But with healthcare, you know, if they take X amount of premium from the customer, and let's say they took too much, like is there like basically there's a cap with health insurance? There's a cap. So if they take too much, there's only so much profit they can keep before they have to give back that amount of money. Is that the same in car insurance? But probably not.
No. So if you I think on that same investor letter from Root, they have a graph of their loss ratio over time. I want to say it was high 60s, low 7. Yeah, so there you go, 65%. Healthcare insurance is 80% is the cap in the United States under the Affordable Care Act. Now, I think like comparing health insurance to non-health insurance plays is something I don't like to do personally, just because everything involved is so different. Like how much people pay for health insurance and how much people pay for car insurance should be two very different numbers, with the healthcare insurance number being way higher. And so it's like, okay, yeah, Oscar's making 20% but like on how much per month, right? People are paying thousands a month if you include the subsidy. And so that piece of it is a little different. But yeah, there's no cap here. So you can price it. The cap is essentially just capitalism. It's like at some point, Progressive is just going to say, okay, we'll give this guy a cheaper policy, and they'll go that way. But
yeah,
the moat that Oscar has, like if you go back to their historical earnings real quick on the other tab, you see they racked up losses for a long time despite not having that much revenue. That's what a company has to do to get the telemetry data to actually be able to price this stuff. That's not easy. And you're basically able to get in at a way cheaper price than before they started this whole process. Now, when they have that model trained, and that model's only getting better. And I think that's like an incredible gift to investors, because in theory, the price should have gone up and to the right during that time, because now, you know, they actually have the ability to go turn a profit.
Yeah, I mean, it's kind of crazy. We're looking at, you know, we definitely did, you know, we have seen, you know, I would love to have been in this at 6, 7, 10, right?
That would have been crazy.
And so they did have a run up, and then they had a fall back to grace, $34, and then they had this massive run up, and they're kind of cooling off. You know, they didn't like the recent earnings, but at the end of the day, it's still just running the numbers. It's massively undervalued.
Mm-hmm. And that's the other thing too, is when stocks are this undervalued, they don't get back to fair value in a straight line. At least never in my experience.
No, definitely
people
not.
Always freak out. People, and for good reason. I mean, people want to take profit. You know, you can't eat like numbers on your Robinhood app. You need to actually sell, and you need new buyers to come in, and that process just takes time. And I think that's what we're really seeing sort of unfold here.
The one thing I'll say though is the people from back here are probably gone. They have probably moved on, at some point, because you got all the way down to $3. I mean, you went from $533 all the way down to $3. So what I'm basically saying here is, when you have this, usually like somewhere like here, and then you come down here, you have this overhead pressure where it's like, if you want to move up in the stock price, you are going to be met with these sellers just saying, I got half my money back, I'm out. With this, where they are now, I don't believe you have this, because I believe over here, these people are gone. Now you more so have long-term investors down here that bought in, dollar cost averaging through here, and then newer investors like me and Centurion, right? Or Contrarian. Centurion, I got you mixed up with weird.
No.
But yeah, so, and look, you can't go back in the past and buy back here. All you can do is just say, okay, what are they doing now? Where are they at now? Is this mispriced? And look, there's a lot of stocks at all-time highs right now. We're starting to see euphoria, I believe, in some stocks, but there's still a lot of great deals out there. I keep finding what I call my high five gems. I keep finding like the D locals, the Zetas, the Oscars, the Roots of the world. We keep finding them because they're still out there. You're always going to have mispricings in the markets, whether that's with small caps, mid caps, or large caps, right? We've seen recently the massive underpricing with UNH, UnitedHealth Group, and it has truly changed people's lives. I'm seeing screenshots of people that have made millions of dollars off leaps on UNH because they just sat there at 250 and said, it could go lower, but something's got to give. Enough is enough. It's a moat company that is just being treated like a penny stock. And what happened? Omaha of Oracle of Omaha bought in, and now, this company's great. We already knew the company was great. We already knew the free cash flow they were putting up. We already knew the moat that they had. We already knew the expanding they were doing.
Right.
It's just
zero new financial information between
zero. None. The lawsuit's still there. The investigation's still there. It's all still there.
Yeah.
But guess what? Because Papa Buffett bought, it's like, oh yeah, actually.
Yeah.
But that's where alpha is, and that's where stock picking can be so lucrative. If you can put aside your emotions and just simply look at the numbers and like what the company and leadership is doing and trying to do. Right? There's definitely companies out there where it's like, man, it's just such a screaming buy based on the numbers, but it just doesn't equate to stock price sometimes ever, and they call those value traps. It doesn't happen too often, I'll be honest, but yeah, it can happen. But yeah, the market gives you time and time again just these crazy deals, and sometimes it's in crazy. It's sometimes, let's just think about. And I'll just like I told everybody this, like I completely missed out on Robinhood, missed out on it, but I had it pegged down. that's the kicker, is with my high five snapshot, I saw that at $19 per share last year, I had it pulled up and I was like, man, I'm getting like 30 to 40% margin of safety with this company. I don't truly know what happened to where I didn't buy into Hood. When it was for free with a discounted cash flow model, it was 30 to 40% margin of safety. I don't know why I didn't buy. But we can look back at those types of things and just say, man, yeah, Hood at $19 based on their free cash flow and based off conservative projections of what they're going to do, screaming buy. And now the price has swung in the opposite direction, and now we're just kind of a little euphoric. We're kind of ran away from the fundamentals. But that can happen with those special companies. Hood, Palantir, NVIDIA, Tesla. Like, these are just special companies with special leadership that just don't miss. They can't miss. They'll eventually miss. And, the stock price will take a beating. But for right now, the Palantirs, the Hoods, the Teslas, the hims and hers, you know, they're just built different.
Yeah, I think that's all a great point. I also wanted to shout out like that emotional piece that you mentioned, which is really where all the alpha comes from. That is not easy. I mean, that takes years to develop. I've, especially early on, like panic sold. I'm sure, maybe I guess I shouldn't assume, but I'm sure that you have as well. Every investor that I know.
Of course, yeah. Everybody has. Everybody will. You can. I'm. You know, Warren Buffett's an amazing investor, but I'm sure that, you know, maybe like 10, 20 years ago, he panic sold something. Maybe.
Probably
Maybe not because he had his
50
business.
years, but yeah.
Yeah.
He's an old guy, right? Yeah, and I think the beautiful thing about it is like, you know, you never really should look at that as losing money, in my opinion. You should look at it as gaining a lesson. Just don't make the same mistake twice, because there's only a couple of mistakes that you can make. And once you get past those, once you learn, I think it gets not just easier, but it gets kind of fun. You know, you get to invest in things that are really changing the world. Like, if I'm looking at Hood, man, I don't think or probably 95% of retail investors would have ever gotten into investing if it wasn't for what Hood did. Like, they legitimately changed the scene of the entire financial world for so many people. Getting to invest in that, kind of cool. You know, or a company like, you know, Ronnie, I know you're a big Tesla bull. That changed the way we drive around. Like, that was one of the biggest industries on earth. No new auto company in 100 years, they came around, they changed the face of the world. And so I think it is cool to get to, you know, participate in that little way.
Yeah. And it can be, you know, we talk a lot about these. I talk a lot about the smaller companies, but I also, you know, understand the fundamentals of the larger companies too. Like, and I continue to say this until I'm blue in the face. In April, in May, when things were looking bleak and everybody's talking about tariffs and the market's just crashing, like, that was really the time to be buying like the Metas, Amazons, Nvidia doubled since then. AMD has doubled since then. Buying those companies that, like, even like Robinhood and Palantir, like Palantir was 60. It's, you know, almost tripled since then. You know, don't buy things that are at all-time highs. Don't go all in when they're at all-time highs. Like, have a plan. Like, what happened in April will happen again in a different form or fashion. It's not gonna. It might not be tariff, you know, and Trump dropping a tariff bomb on everybody. It might be something else. We don't know what it's going to be. We don't know when it's going to be. It could be after the Fed lowers rates next week, if he does. It might not. I think too many people get caught up in, and I get this because I'm a trader as well. I'm a trader, I'm a long-term investor, but I'm able to do, and I try to help other people do this as well, in being left brain, right brain. If you want to do both trading and investing, you really have to do the left brain, right brain. Left brain is completely separated with investing. Right brain is completely separated with trading. You cannot mix the two. They do not mix well. It's like water and oil. They just don't mix. Okay. So if you can do that, great. If you can't, then you either stick to one and do ETFs in the other and forget about it, or you only do investing and you never trade, right? You got to really figure that out for yourself and what you can do, what you can handle, and what you're looking to do. You know, right now there's a lot of newer traders coming in the market, just like back in 2020 and 2021. And there's the euphoria, and I'm seeing a lot of people like, oh my gosh, like, I can't believe, you know, I didn't make 100% this week. Like, what? The average return in the S&P 500 ETF is 8 to 9% per year. What's happening now and what's happened since April is a gift. It's a gift. And people are being rewarded for having the emotional stability to be able to buy during that dip, where a lot of other people were saying, I'm not going in the market because it's just we're going to recession, it's gonna crash, blah, 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 blah. It didn't. Right. So it's just one of those things, guys. Take advantage of the undervalued stocks, the gems, whatever it may be, take advantage of them when they are at just like really good prices on conservative numbers. Yeah, go ahead.
Yeah, I was just going to say, I think it's also worth saying, kind of like you said, there is always a reason for the dip. Like, it's not like next time obviously won't be tariffs, it'll be something else, but it's never like just going to dip for no reason. And when that happens, the like kind of elephant in the room is like everyone's emotions feel bad. Not just retail investors that are panic selling, but like I feel bad. I'm sure you feel bad watching your portfolio be down 20, 30, 40%, whatever it may be. And I think like in that moment, actually, it's good to register, hey, I feel really bad right now, because the buys where I've made the most money are the ones where I felt awful hitting that buy button. When I was buying UNH at 270, 260, I felt terrible because everyone was like, this is a company going to zero. They're going to like arrest the CEO and, it's going to explode. And guess what? That didn't happen. But I think it's worth recognizing that that's where, like, that panic, you don't get to escape it. You just get to recognize it and then very logically say, does that make sense? And it's, even if you can recognize the panic doesn't make sense, we're all humans, we're gonna panic. That's why you're making the money, is because other people who have to make these mistakes first, and that includes people at the institutional level, they're gonna panic, they're gonna do the wrong thing. You have to hang in there and do the right thing. And that's not for everyone, and that's all right.
Yep, 100%. Yeah, you just gotta take advantage of those times. And a little bit of a pro tip: the best time that you'll kind of know when we're reaching a local bottom is, let's say you're really bullish around a stock or stocks, and some people start saying just some wild numbers, right? So I'll give you some examples. When Oscar was down at $11 or $12, people were literally saying that it's going to go to $8 or $5 or $1. And I sat there and I said, yep, we're getting close to a bottom. We did. When people were saying that UNH is going to go to 150, or it doesn't have to be negative, people just thinking like ludicrous, yeah, I'll buy it, like thinking they're the smartest people in the world. Yeah, I'll buy UNH at 150 and then I'll sell it $600 because I'm a genius, because I have the markets figured out. No, I figured out something, how to buy high, sell, or buy low, sell high, that no one else has figured out in all this time in the market. Like, I'm sorry you haven't. No one has. Okay. That's not how this game works. So when people start saying outrageous prices like UNH, yeah, I'll buy it at 150, you're probably pretty close to a bottom, because being at 150 is absolutely ludicrous to where the fundamentals were. Even being at 250 was crazy, right? Same thing with Palantir. People were like, oh, it's at 5, I'll buy it at 2. You never got to buy it at 2, right? Hims and Hers, oh, I'll buy it at 10 or 15. Yeah, you never got to do that again.
Right.
So, yeah, just, you can either dollar cost average, you can either buy based off margin of safety. I do a little bit of both. I plug in conservative assumptions. I want to be buying at the best margin of safety. Margin of safety is distinct. It's simply fair value is here, the actual cost is here. This empty space right here is your margin of safety. So knowing that the stock should be priced here, but we always know that just because fair value is here, it's a pendulum. Sometimes we get ultra bullish and the pendulum swings ultra bullish and it's overvalued, and sometimes it swings ultra bearish and it gets way undervalued. Case in point, Oscar, UNH, Zeta, D-Local, so on and so forth. Root now. I wouldn't say Root is like, it's not like 60% margin of safety. I have it at like 38%, 40% margin of safety, which is still really, really good. It's still really undervalued for what they're doing right now. And as long as they hit their projections and keep up what they're doing, then they're going to be just fine and they're going to continue higher. So.
Yeah. And I think it's also worth saying, like, you don't want to ever go all in on any of these, because there will always be surprises. And so it's important to both be patient. There will be new opportunities. Ronnie, you mentioned you missed Hood. I also missed Hood. That's okay. Learn from it. Don't just, be like, all right, whatever. But do not think that this is the last stock to ever run. Because especially on social media, man, what I see is that the posts that do the best are the ones that are like, you have 2 years to get rich or else AI is going to end the world. And the posts that do really well are like, this is the only company that's ever going to do well. And no, like there's going to be companies that are founded 10 years from now that are going to make people millionaires 20 years from now. And there's always going to be opportunity. And so that lack of FOMO, that patience is so important.
Yeah, couldn't agree more. Whether it's trading or investing, there's always an opportunity. There's always a new stock. There's always a new investment. There's always some mispricing in the markets. Right now, the health insurance sector and health in some of these smaller cap companies, they're still very much undervalued.
Yep.
And what have you seen the last month and a half or so? You've kind of seen rotation out of big tech. You've seen rotation out of semis. You've seen rotation out of Mag 7. You've seen maybe not. I wouldn't even say rotation as much as like profit taking, and they're sticking money in like some of the UNHs, some of the like some safety stocks. They're just really beaten down. So, or where the price is just mismatched. So, yeah. Going through the chat, Rambler, what's up, my dude? Always here. Love to see you, man. Robbie said Rocket Lab's firing today. I didn't even see Rocket Lab today. Did they have a good day?
Either.
Oh yeah, that is 16% weak. Solid. RJ says, what's up? What's up, my man? Root will hit that trend line in 10 to 15 days. How do you think it will react? Kind of hoping for some compression. Yeah, you're talking about the trend line I drew. Let me pull it up. Yeah, so I think where we are right now, I think you're actually going to break. I think you're going to break over this trend line distinctly because this is your volume shelf. This is your point of control. You see, we held this area and now we're bouncing higher, and you have this volume gap here. So it just as it fell through on earnings, we should be able to climb back to at least 123 to 130 area pretty seamlessly. Maybe like breakout retest, and then we come up here and then we kind of consolidate here. That's what I'm kind of seeing on a trading side of things on a technical basis. But really, again, it's just if you want to be in this name for the long term, then the route is buy and hold. SoFi stock. SoFi is just going higher.
SoFi's like a crazy heater. I mean,
yeah, SoFi's been it's been
how
flying.
much is it that we bought this at 9 earlier this year?
Yeah, and this is the thing that people don't understand. That right here, this is like very comparable to Oscar, to Root, to DLocal, to Zeta, to even UNH, to a lot of these companies that they're in this consolidation period, and everybody's like, I want these gains. I want these massive gains. How do I get these massive gains? Well, it's by being patient in here. You can't have this unless you're patient in here. Okay? It's very simple. You can't have this massive gain unless you're patient in here. And also, they will throw some crazy curveballs at you. You break out and you're sitting there, you're like, yes, we're on top of the world, $16 per share. And then they dump on you back down to sub 10. As long as you realize that we are having a higher low than what we had in July of 2024, and then a higher low in March of 2025, and then that was simply just a higher low, and then we went a lot higher from there. Again, it's just not getting caught up in the day-to-day, all the hoopla. All the hoopla is
Hey guys,
don't get caught up in that.
I will catch you guys later. I hope everyone has a great weekend.
All right, man, take it easy. Have a great weekend.
Have a good one.
Adobe. I think Adobe did good on their earnings, but then they didn't run, I believe. They did nothing.
Yeah, I think the SaaS space overall is a great example of what we were talking about, where like,
Yeah, I was gonna say that too.
yeah, these companies aren't going to get replaced per se. I mean, you might see market share shift around a little bit, but there's no way you're going to convince me. Like, my conviction personally is strongest with Salesforce. There's no way you're going to convince me Salesforce is just going to stop existing as an entity. These guys are, nobody's making CRM in-house. I mean, if you're like, if you're a bagel company or something, you're not going to sit there and hire 12 devs and tell them like, oh, use AI to make a brand new CRM. And it's like, the market's going to freak out. I don't think we're at panic quite yet, which is why I haven't personally started to nibble on some of these names. And, if that means that they get away from me, that's all right. But I think that there's going to be an opportunity here in the not so distant future, probably going to take a bit of a market downturn and some, fears about the macro. But like, there's no way that Adobe deserves this. They're trading at the same level that they were in like 2020.
Yeah.
And, in today's day and age with like TikTok marketing being so big, there's no way that you can't use their software. They are, for a lot of things, the only game in town. Who's competing with Photoshop? Who's competing with, and like, what serious marketing department is making stuff with anything other than maybe Figma? And I guarantee you any big company's using both. There's no like real wiggle room to just abandon Adobe altogether.
Yeah, I agree. I mostly agree with, we saw the SaaS companies get that FUD around them in 2024. And we saw CRM and Adobe and a lot of these companies take a big nosedive. I don't think we're quite there yet on them. I think there's more room to go. And I think that because we are at all-time highs, and if we do have a 5-10% pullback in the markets, I think these names get hit even a little bit more.
Right.
Now, this is where it's tough though, because I would say more so CRM has more room to fall. Adobe, it's kind of hard. It's kind of hard because you're telling me we're going to go back down to COVID levels or 2022 levels, right?
Right.
So it's kind of hard for me to see that. It could happen, but right now, as long as 331 holds, you're just putting in a double bottom on Adobe. You're kind of trying to break out over this downtrend. And if that happens, then yeah, you're gonna see Adobe retrace back up into $400, $500, $600 per share. And guys, like, did we not learn our lesson from Google? I mean, did we simply not learn our lesson from Google? And I'm not talking to the audience. I'm talking to like Wall Street and stuff. Guys, how many times did people say Google's gonna die? Blah blah.
Are they still around? I heard that their
stuff.
business was actually over.
Yeah.
Yeah, I heard
I think they went bankrupt. I think they went bankrupt.
Most profitable company on earth.
Yeah, but you pulled up. Everybody was pulling up. Not everybody. Only a couple people. Pulling up the charts of, okay, what's Google doing? Okay, up and to the right, 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 up and to the right. Free cash flow hit a little bit, but free cash flow can ebb and flow, but still it's higher than it was in 2022. And again, that's quarterly actually. So there you go. Hockey stick, hockey stick, hockey stick. And the thing about
sorry, I just want to throw in one thing. For investors that might be, especially younger investors that might be confused, the reason free cash flow can look so lumpy while things like earnings per share look kind of smooth is just because what free cash flow means is like how much money did you actually have coming in the door minus how much money did you have going out the door. And so when you do accounting, sometimes money coming in the door, you like spread that out over time. So for instance, if I'm buying a high five subscription, but I'm paying for the year, maybe Ronnie accounts that all at once and maybe accounts like a lump of that every month. But in his free cash flow, he has to say that all came in this month because like the money literally transferred this month. And so when he recognizes that, it would be his EPS and the earnings and the net income, but the free cash flow has to show that. And that's why investors tend to like, especially trailing 12 months free cash flow, because you can't really fudge it. it is like how many dollars actually came in the door. And so I just wanted to throw that out because it's something that confused me for a long time. And that's really the difference. And that's why investors like free cash flow.
Yeah, it's using a discounted cash flow model is kind of like my my superpower, I would say. Just being able to run projections based on discounted cash flow. If you are able to do this with conservative measures and do this right, you could have got into HIMS in the beginning, Hood in the beginning, Palantir in the beginning, NVIDIA in the beginning, Tesla in the beginning. All these companies, what do they have in common? They were doing very well with the free cash flow and showing that with conservative projections of them continuing that, they're actually massively undervalued. While people are screaming, but the PE is so high, but they're only doing 5 cents of EPS a quarter or a year for Palantir. With growth companies, typically what you see, besides some outliers like SoFi, banking and finance is different. Okay. But for a lot of these other growth companies, you're typically going to see that free cash flow rising and coming out the gulag before anything else, like before EPS. It's not going to be an EPS story until later down the road. Some companies do it different, like honestly, CRM, since we were talking about that, they were more so a net income company. And then now they're really starting to spin up that free cash flow in a big, big way, which I do like that. But yeah, I'd like to see them fall a little bit more. Adobe, yeah, it's just crazy because not only, guys, are they increasing revenue quarter over quarter, year over year, net income and cash flow, but they are buying back shares. They're taking a page out of Apple's book. They're buying back shares like crazy, guys. They've gone from 590, call it 94 million shares, all the way down to 441 million shares. That is outstanding. And that, for me and you, the shareholders of this company, is what we want. They're giving you a bigger slice of the pie. They're giving you a bigger seat at the table. Okay. So, yeah, Adobe. And again, I wouldn't even say like they haven't made Adobe a screaming buy either, but it's definitely a really good buy. It's definitely a really good buy. And it will, just to be honest, it's really hard to get a company to be a screaming buy when they're this big, $148 billion market cap. You're not going to see the mispricing that you see with like a Root or Oscar or something like that typically, unless you get, bear markets or recessions. So
I do have to hop off, but thank you so much for having me on. Appreciate it.
Yeah, we'll just wrap it up for sure. That way I can go hang out with family.
Yeah.
My kid's screaming upstairs. I hear him.
See you. Thanks.
Yeah.
Thanks, everyone.
Yeah, appreciate it, man. Have a great weekend, okay?
You too. Bye.
All right, guys. Appreciate all of you. Sorry I didn't get to all your comments. I appreciate everybody joining in. Thought it was very productive. A great call with Nick and Contrarian Capital. Again, if you didn't follow him yet, give him a follow. Have a great weekend, everybody. Stay safe out there, and just get some R&R this week, because next week we got Fed meeting, we got rate cut on the table, so it's gonna be a crazy week, guys. So get some rest up, relax, go touch some grass, and have a great weekend, guys. I'll catch you guys in the next one. See ya.